Have you ever wondered what a bank actually does with the money you deposit? Well, it's not just sitting there gathering dust. Banks are much more than colossal vaults. They take on a vital role in the economy by acting as financial intermediaries. Here's how it works. When you deposit money into a bank, they don't just hoard it. Instead, they lend a portion of it to other customers who need loans for various reasons, such as buying a house or starting a business. The bank then charges interest on these loans, and that's how they make a profit. But don't worry, they can't lend out all your money. Banks are required to keep a certain amount in reserve. This is to make sure they can cover their customers' withdrawals and maintain financial stability. So, in essence, a bank works as a financial intermediary, connecting savers and borrowers. What happens when a government simply decides to print more money? It's a question that tickles the mind, doesn't it? Let's explore this concept together. When a government prints more money, it doesn't magically create more wealth for the country. The wealth of a country is determined by its production of goods and services, not the amount of money in circulation. Think of it like a pie. If you slice it into more pieces, you don't get more pie, just smaller pieces. Now, when more money is introduced into the economy, without a corresponding increase in goods and services, we have more money chasing the same amount of goods. This can lead to a situation called inflation, where the prices of goods and services increase. So, while the idea of just printing more money may seem appealing, it's not a solution to economic struggles. Therefore, printing more money doesn't make a country richer, but it can make each individual dollar worth less. But is inflation always a bad thing? Not necessarily. To understand inflation better, let's think of as a seasoning in the recipe of an economy. Just like a dash of spice can enhance the flavor of a dish, a moderate amount of inflation can actually stimulate economic growth. It's a common economic phenomenon where the levels of goods and services increase over a period of time. When inflation is in a controlled measure, it encourages people to spend and invest. This is because the value of the currency decreases with time due to inflation. So people prefer to invest or spend it, rather than hoarding. For example, if a country has experienced 50% inflation over a 10-year period, £10,000 sat quietly in the bank. Over that same 10-year period, will be able to be exchanged for 50% less goods or services. At the end of the 10-year period, as goods and service prices rise to compensate the inflation. So essentially, you can do 50% less with the money, and its buying power is worth a lot less in today's money compared to what you could have bought when it was initially banked. Crazy, right? Consider a scenario where you've been saving for a dream car, but by the time you've amassed enough savings, the price has skyrocketed. That's the impact of high inflation. It can be incredibly frustrating. Moreover, unchecked inflation brings about economic uncertainty. This instability can make it challenging for businesses to forecast and plan, which could hinder economic growth. Thus, it's clear that while inflation can boost spending, it needs to be carefully managed to avoid causing instability in the economy. A real-world example of this is the COVID-19 furlough scheme. This system saw nearly 12 million people receiving 80% of their salary for simply sitting at home. Sounds like a windfall, doesn't it? But there's a catch. A whopping £70 billion was distributed for essentially no work. This increase in circulating money with no corresponding increase in goods and services naturally leads to inflation. In 2014, Britain had 3 billion banknotes in circulation. Today, there are 4.6 billion, a 65% surge. This massive increase in printed money, without an equivalent increase in economic output, means the currency's value has diminished by 65% in the global economy. This necessitates a 65% surge in inflation to balance the economic scales. House prices rise, so the original lenders or mortgage company can match inflation and purchasing power with the returns. The bricks aren't worth more, but the bank needs to make a profit, so the price of your home rises to compensate. The lesson to be learned is this: when your government offers you free money, remember, there's no such thing as a free lunch. The cost of goods will inevitably rise to balance out the extra money in circulation. Inflation is a complex mechanism, and understanding it can help us make more informed financial decisions. That's all for today. Take care, and remember to spend wisely.